Basel, a winter night. The Rhine runs black under bridge lights, cutting through a continent stitched together by treaties, trade, and debt. The air has a clean, metallic cold that stiffens hands and turns breath into a thin fog. This is not a capital that commands with flags and parades. It's a border city where jurisdictions overlap and money moves faster than parliaments. Out beyond the riverbanks, a crisis is already accelerating, not with sirens, but with widening spreads and tightening credit. The first signs of a stampede. Inside a building of pale stone and sealed glass, the world goes quiet. Carpet hush, leather chairs, doors that close with a soft seal, a wall clock that does not hurry. Phones ring in different time zones while aides lay out folders, clipped pages, margin notes, numbers circled in ink. The atmosphere is controlled on purpose. No spectacle, no crowd, no public panic to feed. This documentary compresses complex history. Where records conflict, we will flag ambiguity rather than force certainty. If you value cinematic history told with evidence and restraint, consider subscribing. Hands turn pages and steady a ruler along a paragraph. Ink-stained fingers tap once, not for drama, but for timing. A pen scratches, pauses, scratches again. Lamp smoke hangs faintly above polished wood. A cuff is scuffed from travel. Damp wool dries slowly in heated air. On a side table, a glass of water sits untouched beside a stack of documents. Definitions nested inside definitions. A crisis moves faster than speeches can catch it. The public will be shown a press conference and a headline, then sent back into their lives with a single word, liquidity, as if it were weather. But liquidity is not weather. It is permission. Permission to keep paying, keep borrowing, keep clearing obligations that come due on the hour. Basel's hidden hub is not a vault. It's a junction box, where central banks meet, where standards are drafted, where the language of balance sheets is translated into discipline. It does not command armies. It does not pass laws. It shapes the ground that others are forced to cross, and it does so through rules that look technical until the day they decide who survives. This is the tension. Markets always wobble. The clock starts when wobble becomes flight, when lenders stop renewing short-term funding, when a bank that looked healthy last week can't roll debt this morning. The difference is not philosophy. It is arithmetic. A spread widens. Collateral is questioned. A funding desk hears fewer answers, and suddenly solvent and illiquid become two different doors, only one of them open. The decisive action rarely arrives as a dramatic rescue. It arrives as a rule, a definition, a settlement convention, a capital ratio that turns risk into a number that can be enforced, a line in a protocol that decides who can be sued, who cannot, and where disputes go to die. Paper first, consequences later. Mechanism. Moment. This is how the world is restrained without uniforms. Modern finance runs on clearing, on payments that must settle, not someday, but today. A bank's promises aren't abstract. At set times, money has to move through systems that close their ledgers and reconcile their accounts. If a bank owes another bank at noon, it must deliver funds through a chain of counterparties that live on deadlines and trust. Trust is enforced through collateral, capital, and rules about what counts as safe. Those rules are physical in their effects. A clerk checks eligibility lists. A risk officer stamps a form. A collateral manager moves assets in and out of legal control, guided by a settlement calendar that doesn't care about excuses. The tools are plain. Printed schedules, secure messages, signatures, seals. But the coercion is real. If your collateral is downgraded, you can borrow less. If your capital ratio falls, you must raise money or shrink. If your liquidity coverage fails, the market begins to treat you as a liability. In the language of finance, it sounds clean. In the real economy, it is rationing, and rationing leaves marks. It shows up as cancelled shipments and delayed payrolls. It shows up in firms that can't bridge a month because credit has tightened to a choke point. It shows up in exhausted treasuries forced into harsher terms. On the street, it becomes smaller choices made under pressure. Fewer repairs, fewer hires, thinner margins, soot under nails from extra shifts, cracked leather shoes worn another season, bread that tastes faintly of ash because the cheapest flour is what's available. None of this is announced as policy, yet it spreads through the system like attrition through an army. Basel's influence comes from making certain choices feel inevitable. A formula looks neutral when it reads like mathematics, but every formula has distributional force. It decides who must hold more capital and therefore lend less. It decides which assets count as high quality and which are treated as suspect. It decides where risk is allowed to live, inside regulated banks under scrutiny, or pushed outward into less visible channels. It decides which institutions are protected because their failure is deemed intolerable, and which are left to collapse because their collapse is considered containable. That leads to the hard choice at the center of every crisis. Provide support and risk encouraging future recklessness. Refuse support and risk systemic contagion. Announce the truth and risk panic. Delay the truth and risk a sharper break later. There is no clean path, only controlled damage, negotiated under time pressure. The room in Basel is designed to keep people calm while the world outside cannot afford calm. Leather chairs, quiet corridors, glass walls that mute the city. Yet nothing here is gentle. A standard drafted in this building can force banks across continents to change behavior, raise buffers, cut leverage, sell assets into falling markets, protect themselves by tightening credit on everyone else. It is governance by constraint. No speeches, no votes, just incentives that bite. Historical ambiguity. Even in well-documented modern crises, investigators often dispute the precise trigger, whether it was insolvency, illiquidity, or the timing of fear. What's certain is that the turning point is often invisible at the moment it happens. Not the wobble on the screen, but the clause on the page. Not the rumour, but the definition of what counts as safe. Not the speech, but the settlement rule that decides whose claim comes first. But the decisive turn wasn't the clash. It was the paper and seal that followed, and to understand how rule writing becomes power, we have to go back to older empires, where coin, tribute, and default decided outcomes as surely as steel. Europe after the First World War is a continent with its arteries damaged, rail lines patched, ports half idle, borders redrawn with new customs posts and fresh resentments. Winter brings coal shortages and the old memory of rationing, thin soups, darkened streets, damp wool pulled tight at the collar. Governments try to stand upright on exhausted tax bases, while currencies wobble under the weight of promises they cannot fund cleanly. Across this terrain, reparations are not just punishment. They are a pipeline of payment demanded by treaty, and every mile of that pipeline runs through politics, legitimacy, and the risk of collapse. Picture a finance ministry corridor in a central bank office, linoleum worn at the edges, paper stacked in tied bundles, the smell of lamp oil and stale tobacco in the air. Clerks copy figures into thick books with neat columns, then add them again because a single error can become a scandal. In the street outside, men queue for work, boots scuffed, shoulders hunched against cold air. Shopkeepers watch coin edges and banknotes with the same suspicion, because tomorrow's value is no longer guaranteed by habit. In council rooms, quiet, guarded, creditors demand payment as proof that the post-war order means something. Debtors insist they cannot pay without tearing their economies apart. In the narrow sense, everyone is right. In the wider sense, everyone is trapped. Reparations are framed as morality, but they behave like engineering, collection, conversion, transfer. The money must move across borders, through currencies and gold, under laws that do not trust one another. A ledger page lies open. Neat columns, red ink for arrears, a blot at the margin where a pen paused too long. Fingers stained with ink turn the page carefully, as if the paper could tear and take the whole arrangement with it. A stamp comes down, thud, on a form that authorizes movement. Not soldiers, not grain, but claims. A leather satchel closes with a tired buckle. Somewhere nearby, a telephone receiver is set down softly, because even sound feels dangerous. The Bank for International Settlements is born from an accounting problem that never stayed on paper. After the war, treaties demand reparations. Creditors demand proof that the debts of war will be acknowledged in cash, not in sentiment. Debtors face a different arithmetic: pay too hard, and the domestic order fractures: wages, pensions, policing, food imports. Every cabinet understands that legitimacy is a material condition. It depends on bread arriving, coal burning, salaries paid on time. It depends on not looking helpless. Germany's reparations in practice require machinery. A scheduled stream of payments cannot simply be wished into existence. It has to be collected inside Germany, converted into forms acceptable abroad, and transferred through banks, currencies, and gold into creditor hands. That is where the poison sits. If the mechanism is housed in Berlin, it looks like surrender administered at gunpoint. If it sits in Paris or London, it looks like domination disguised as bookkeeping. The site must be politically survivable, neutral enough to be tolerated, close enough to the industrial heartlands and rail corridors that still matter. Basel offers that geometry. A border city in Switzerland, accessible, discreet, and plausibly technical. A place where central bankers can meet without announcing a summit. Where coordination can be practiced under the cover of administration. The institution that emerges, the BIS, is not built out of idealism. Its founding logic is containment. A bank designed to handle transfers and trusteeship, and to provide a room where the people running money systems can speak plainly when politicians cannot. Mechanism moment. What does a reparations pipeline actually look like? It looks like paperwork, gold, and enforceable deadlines. A payment schedule is written into legal instruments, annuities, bonds, trustee arrangements, so that obligations become standardized claims rather than constant diplomatic brawls. Once claims are standardized, they can be serviced through recognized channels, but the channel still needs backing. Under the gold standard, currencies are tied, directly or indirectly, to gold reserves. Foreign exchange and gold are not abstractions. They are survival stockpiles. When reserves drain, imports become harder to pay for. Coal, wheat, machine parts, everything tightens. So every transfer carries a second cost. It weakens the payer's ability to defend its currency and keep trade flowing. This is why the BAS matters as a conduit, not because it creates wealth, but because it can administer scarcity with procedure. It can hold collateral, act as trustee, and manage the timing and routing of payments through a system that depends on confidence. In a world of thin reserves, timing is coercion. If a deadline hits and the gold isn't there, the consequences cascade: currency pressure, credit withdrawal, political humiliation. A bank built for these operations becomes a stabilizer not by generosity, but by making the process orderly enough to prevent a brawl from turning into a rupture. Material life in this moment is brittle. In cities, unemployment lines lengthen. In rural regions, debt bites. Mortgages, arrears, auctions. Governments must fund pensions and policing while revenue fails to keep pace. They print, they borrow, they improvise. But the international system is not sympathetic to improvisation. It demands settlement. It demands credibility, and credibility is purchased with reserves that can be measured. The Young Plan of 1930 tries to turn a political feud into scheduled annuities, an attempt to make time do what force cannot. The BS is created as the technical agent for that scheme, to administer payments, to act as trustee for international loans, and to host central bankers who need coordination without public admission. Its boardrooms are designed for quiet for a reason. Discretion is not style, it is a tool because every visible concession has domestic costs. The tension engine is structural, and it is already ticking. The reparations pipeline is being built just as the global economy begins to lose its footing. The system depends on steady transfers, steady credit, steady confidence. But confidence is fragile. It can calcify into suspicion overnight, and once it does, everyone hoards. Gold, foreign exchange, liquidity, like a besieged city hoards grain. Historical ambiguity. Historians still debate how much the reparations burden versus broader financial fragility drove the speed of the early 1930s breakdown. What is clear is the design choice. The BS is formed to manage coercion politely, to make obligations enforceable through procedure rather than threat. But a mechanism built for steady transfers faces a brutal test when the world economy seizes and transfers become impossible to sustain without breaking something else. And when credit freezes and gold stops moving, a bank built for orderly payment must decide whether it remains a conduit or becomes an instrument of triage. The 1930s don't arrive with banners. They arrive as contraction, credit narrowing, trade shrinking, and confidence evaporating across borders that suddenly feel hard again. From Hamburg to Vienna to New York, the same geometry repeats. Banks hold assets that are someone else's promises, and when one link snaps, the strain races down the chain. Ports empty. Rail traffic thins. Governments face desolation not just in output, but in legitimacy, because a state that cannot keep money stable cannot keep order stable for long. Over this entire map hangs one ticking clock: credibility, measured day by day. Inside bank halls and ministry offices, the crisis is not abstract. It is paper and queues. Counter windows with worn brass rails, ledgers piled high, pages softened by handling, clerks in dark jackets, sleeves slightly shiny at the cuff, moving stamps across forms until the ink pad goes dry. Outside, unemployment lines curl around corners. Foreclosure notices go up. In markets, people weigh coin edges and stare at banknotes as if the paper might betray them overnight. In boardrooms and committee rooms, language becomes careful. Central banking is a profession built on controlled phrases because a single careless sentence can trigger a run. Meetings in capitals create headlines. Meetings in Basel create coordination. And coordination is what remains when treaties and public goodwill have begun to fail. A gold bar is lifted with both hands and set down on felt. Cloth wraps its sharp corners, then is pulled tight and tied. A stamp strikes the surface, one mark then another, authority made visible in metal. A seal is pressed into wax on a document authorizing movement. Ink blots at the margin where the pen hesitated. The air smells faintly of lamp smoke and cold stone. The work is quiet, but it is not gentle. The BES is barely alive when its original mission begins to die. It was created to administer reparations, structured payments intended to keep a political feud from becoming an open wound. But the Depression turns the whole machinery into a liability. What looked stable in one country's balance sheet becomes poison when exchanged into another's currency. Loans that once crossed borders with ease begin to stick. Gold drains. Foreign exchange tightens. The system that made reparations payable depends on flows that are now choking. In 1931, Germany's banking crisis and the broader panic make the reparations pipeline politically and financially untenable. Moratoria arrive, not as triumph, but as triage. Negotiations try to salvage dignity from default, because default is never just a number. It is a public admission that promises are no longer enforceable without breaking the state that made them. By 1932, the Lausanne Agreement effectively ends reparations as originally conceived. The BS's founding purpose, collect and distribute payments, shrivels to a formality. If it remains only that, it becomes an empty building with a fading mandate. So the institution pivots, not with a manifesto, but with necessity. Central banks still need practical work done: reserve management, currency operations, gold deposits, and, most importantly, a forum. In a world where cabinets fall and parliaments scream, central bankers still have to compare what they're seeing: gold outflows, bank runs, exchange rate pressure, the credibility of promises that are now cracking. Material reality sharpens the stakes. For ordinary people, the Depression is hunger, layoffs, foreclosures, and political radicalization that feeds on humiliation. For institutions, it is a constant question of liquidity. How much cash can be raised without detonating confidence? Liquidity is not a slogan. It is the ability to meet obligations today without forcing a sale that proves weakness, and weakness, once seen, spreads. Gold becomes a fetish because it seems like the only asset that doesn't depend on someone else's promise, until it does. Governments begin to restrict it, seize it, or trap it behind controls. The public sees headlines. The system beneath those headlines is more mechanical: forms, permits, and barriers that decide whether money can leave a country at all. Mechanism. Moment. Exchange controls and emergency operations. When confidence collapses, governments and central banks reach for tools that are both legal and physical. Exchange controls mean that moving money across borders is no longer a choice made in a bank office. It becomes a permission granted by the state. Importers need licenses. Banks need approval to buy foreign currency. Transfers are delayed or denied, and the denial itself becomes a signal of distress. A country can slow capital flight, but it pays a price. Trade suffers, trust erodes, and the economy begins to calcify behind its own walls. At the same time, central banks still need to move reserves in ways that do not invite panic. Gold shipments are planned like sensitive logistics, wrapped, sealed, insured, recorded in ledgers that must reconcile down to the last unit. A single missing bar is not merely theft, it is an international incident. Intercentral bank operations, swaps, deposits, short-term credits offer breathing room, but they also create entanglements. One bank's support becomes another bank's exposure. The BIS starts to function less like a reparations clerk and more like a switchboard, routing information, facilitating operations, reducing friction where politics has made direct contact toxic. Human constraints shape every decision. Central bankers are not immune to fear of contagion, fear of political interference, fear that one wrong public phrase will trigger a run and turn a slow crisis into a stampede. Ambition is present too, the desire to preserve autonomy, to prove competence, to keep control of the levers, while governments demand miracles and scapegoats. In this environment, discretion becomes a form of protection. Quiet meetings, carefully drafted communiques, agreements that are real but never advertised. The tension engine is a daily countdown of credibility. Every day confidence holds, the system survives one more night. Every day it doesn't, a government reaches for harsher controls, nationalism hardens, and the space for cooperation narrows. The BIS's usefulness grows precisely because public cooperation becomes politically radioactive. It can host the conversations that cannot happen elsewhere, and it can execute the operations that are easier when no cameras are present. Historical ambiguity. Scholars disagree on how much of the early 1930s collapse was driven by specific banking failures versus the deeper structural flaws of the international gold and credit system. By the mid-1930s, the mission has changed in practice, even if the building looks the same. The BIS is no longer defined by reparations flowing neatly through scheduled annuities. It is defined by survival operations, gold, reserves, controls, and a forum for coordination in a world where coordination is increasingly punished at the ballot box. And as war approaches, this habit of discrete service collides with a darker problem. What neutral finance becomes when reserves are seized, borders are conquered, and the gold itself is no longer clean. By the late 1930s, Europe is not merely tense, it is rearming. Borders are watched, rail corridors become strategic lines, and timetables read like deployment plans. States that still remember inflation and bank runs now prepare for something worse. Vaults taken at gunpoint, ministries occupied, reserves seized in a single night. Gold begins to move not because anyone expects profit, but because catastrophe has become a planning assumption. The geopolitical scale is simple and brutal. If invasion comes, whoever holds the reserves holds the breathing room. On station platforms and in freight yards, the work is procedural, not heroic. Crates are stenciled, weighed, and sealed. Manifests are typed and checked twice. Insurance is arranged in careful language that avoids naming the real fear. A customs official looks at papers, then at faces, then stamps the page. In bank corridors, the air smells of damp wool and cigarette smoke. Messengers carry satchels close to the body. In Basel, behind pale stone and sealed glass, the BIS continues to offer services, deposits, transfers, custody, while the continent fractures around it. Inside the institution, there are no sirens. There are protocols, account statements, meetings that happen in controlled language, because public coordination has become politically toxic and soon physically dangerous. The quiet is not peace, it is insulation. A cracked wax seal on an official order, broken cleanly down the middle, a signature line filled in with steady ink, a ledger entry rewritten with a new account name, the old one crossed through with a single final stroke. Fingers press a stamp into an ink pad. Then down onto paper, thud, authorizing a transfer that looks routine until you remember what sits outside the building, occupied capitals, coerced officials, and armed men who do not need a courtroom. Gold is the last asset people reach for when promises fail. In the Depression it became a refuge. On the eve of war it becomes a lifeboat. Central banks shift reserves to safer locations, sometimes across borders, sometimes across the Atlantic because a vault can be captured and a government can be replaced, but an overseas deposit might remain usable. None of this is romantic. It is crates, rope burn on hands, metal corners biting through cloth, and the knowledge that the wrong delay can make the whole movement meaningless. The BIS sits in the middle of this motion, as a service institution that outlives treaties. It is designed to keep channels open between central banks, channels that remain valuable even when diplomacy collapses. That continuity is its strength. It is also its hazard. Because continuity can become camouflage, business as usual can preserve function and at the same time give transactions rooted in force the appearance of normal legitimacy. The story turns cold in March 1939 when Germany occupies Czechoslovakia. In an occupied capital, orders are transmitted and accounts are relabeled. A transfer is executed from one account to another. On paper it is administrative, a debit here, a credit there, but the context is coercion, officials operating under threat, a new regime insisting it owns what it has seized. What looks like tidy bookkeeping becomes a mechanism by which conquest is translated into usable reserves. Mechanism. Moment. This is how stolen value can be made clean by procedure. Gold in a vault is not just metal, it is identified property, bars with markings, weights, and assay stamps. Custody is recorded in ledgers. Transfers are authorized through signatures, seals, and account instructions that institutions treat as binding. In normal times, these procedures protect sovereignty. They prevent theft by requiring proof and documentation. In wartime, the same procedures can be turned inside out. If the authority issuing instructions is backed by force, paperwork can become the bridge between seizure and legitimacy. A bar can be moved, re-registered, melted, recast, and stamped again. A new serial, a new entry, and the origin becomes harder to prove in real time. During the war, the BIS continues operations. Gold moves, interest is paid. Statements are issued with chilling clarity while outside the boardroom cities burn and rationing tightens. The material contrast is stark. Ash in bread, lamp smoke in stairwells, swollen feet in queues, and then, inside, polished wood, clipped pages and tidy columns. Some central banks use Basel to keep assets functional, under conditions that would otherwise freeze them. In a world of blockades and controls, a functioning channel is power, but the same channel can serve darker flows. Allied investigations after the war focus on looted reserves, gold taken from central banks in occupied countries, then absorbed into wartime finance. The question is not only quantities, but provenance and procedure, which bars, which accounts, which authorizations, and what was known when. Records indicate the BIS received a limited quantity of gold via the Reichsbank, and later returned an equivalent amount through restitution mechanisms. The numbers matter, but they are not the full story. The full story is institutional. Whether the BS should have been operating at all under those conditions, and what neutrality means when the surrounding system is run by terror. The tension engine here is reputational survival under existential pressure. If the BIS shuts down, central bank cooperation loses a discrete channel at the very moment the world is fragmenting. If it stays open, it risks becoming a stain that outlives the war, an institution that can be accused of turning coercion into paperwork. This is the hard choice: preserve function and risk complicity, or refuse function and accept financial desolation in a landscape already collapsing. Historical ambiguity, disputed point. How much BIS leadership understood in real time about the provenance of specific wartime gold transfers? Documentation is uneven and later accounts are filtered through post-war self-justification. When the guns finally fall silent, the problem does not. Files remain. Ledger entries remain. The cracked wax seals remain, and so do the questions they authorized. Basel's discrete continuity has kept a channel open through the war, but the price of that continuity now arrives as scrutiny, accusation, and the demand for moral accounting. And once victory replaces emergency, the victors must decide whether Basel's institution is a tool for rebuilding or an unacceptable relic that deserves dismantling. In 1944, while war still burns, planners gather at Bretton Woods to design a new financial architecture. Fixed exchange rates, a dollar anchor, institutions meant to prevent the interwar collapse from repeating. On paper, it is clean. The IMF, the World Bank, rules that promise predictability where panic once ruled. From that high vantage, the BS looks like a relic from the old disorder, born of reparations, compromised by wartime controversy, built for a Europe that has just destroyed itself twice. A resolution is drafted to liquidate it at the earliest possible moment, a deliberate severing of older networks in favour of a formal, American-led order. But after 1945, Europe is not a policy paper. It is rubble and shortages. Railway yards are twisted metal. Warehouses are empty. Coal is rationed. Wheat is a political emergency. In ministry corridors, boots track in soot. Clerks work in coats because offices are cold, their breath visible above stacks of forms. In markets, people trade what they have: cigarettes, soap, scraps, because currency is weak and trust is thinner still. Governments are trying to keep populations fed and calm, knowing how quickly hunger can turn into radicalization. In that atmosphere, slogans about rules collide with the material problem of restarting trade. If every deficit must be settled immediately in gold or dollars, commerce ceases. Reserves are scarce. Currencies are fragile. A rigid settlement requirement becomes a blockade by paperwork. A stamped clearance slip, edges worn by handling. Ink rubbed thin where fingers keep pinching the same corner. A clerk presses a seal into a form, and the paper dents slightly, the mark hardening the decision. A pencil line totals columns, then circles a final figure. A coffee cup sits cold beside a blotter. The room smells of damp wool and ash. Outside, a truck idles, waiting for authorization to move goods that have become political lifelines. This is the hard choice: cleanse the post-war order by shutting the BIS down, or use it because Europe cannot afford purity. At Bretton Woods, the intention is blunt. Replace the old, discrete central bank networks with institutions that are visible, rules-based and publicly legitimate. After the war, that logic meets a continent that can't wait for ideal systems to mature. Hunger is urgent, fuel is urgent, trade is urgent. A rules-based order is noble, but desolation has its own deadlines. In that gap, between design and necessity, the BS survives. Central bankers argue quietly that Basel's institution can do something the new Bretton Woods bodies are not built to do quickly: act as a technical agent for practical clearing arrangements among European states that need trade more than symbolism. The politics are delicate. Politicians talk sovereignty. Economies demand imports. Central banks want stability without being blamed for austerity they cannot avoid. Everyone wants to look independent, but no one can rebuild alone. The compromise arrives in a form that feels almost brutally unsentimental: the European Payments Union in 1950, with the BIS serving as agent. Not a grand treaty that stirs crowds, a mechanism, a system that makes trade possible when reserves are too thin to settle every imbalance immediately. Mechanism, moment, how the EPU works in material terms. Trade creates debts and credits across borders. One country imports coal, another exports machinery, a third sells food. In a simple world, every deficit country would have to pay each surplus country directly, in gold or dollars, on the spot. Post-war Europe cannot do that without choking. So the EPU nets balances multilaterally. Instead of dozens of bilateral settlements, the system tallies totals. A country in deficit owes the Union. A country in surplus is credited. Settlement is managed in phases, part cleared through credit lines, part through limited hard settlement, under rules that prevent permanent free riding. You can picture it on the ground. Bills of lading arrive, customs paperwork is filed, importers need foreign currency, exporters demand payment. In Basel, totals are calculated like a ledger war, columns of claims and obligations reduced to net positions. The numbers then become constraints with teeth. Deficit countries face limits and conditions, pressured to adjust rather than drift. Surplus countries gain credit but are also pushed indirectly to keep trade flowing rather than hoard. The system is not charity. It is controlled flexibility, a rationing of settlement itself so that commerce can restart without detonating reserves. This is where Basel's institutional logic hardens. International cooperation stops being a speech and becomes a spreadsheet backed by enforceable rules. The BIS is not legislating, it is operationalizing. It designs processes that states adopt because the alternative is economic strangulation, blocked imports, collapsing currencies, and political unrest. Human constraints define the entire arrangement. Central bankers speak in measured terms because confidence is still a thin crust over trauma. They have to keep exchange rates from spiraling, while governments demand growth and relief. They have to accept discipline without being seen as foreign agents. and they have to preserve enough autonomy to act quickly when markets test them, because the post-war system is not stable by nature, it is stable by constant maintenance. Historical ambiguity. Some post-war accounts differ on how close the BIS came to actual liquidation, because decisions were shaped as much by quiet bargaining as by formal resolutions. By 1948, the liquidation effort is set aside. Basel remains, not because its past is forgotten, but because its utility is immediate. The BIS becomes a tool for rebuilding precisely where ideology falls short. The daily mechanics of clearing, settlement, and constraint, executed quietly so that governments can keep moving wheat, coal, and machine parts without admitting how dependent they are on cooperation. And once Basel is accepted as useful again, it evolves from post-war improvisation into permanent quiet governance, where standards, not speeches, begin to shape how states behave. By the late 1950s, the post-war order is running on a promise that is expensive to keep. Exchange rates are meant to hold steady, and the system is anchored to the dollar, while the dollar on paper is anchored to gold. But economies expand, trade thickens, and the demand for dollars outgrows the metal behind the guarantee. This isn't ideology, it's arithmetic, playing out across shipping lanes, factory floors, and central bank vaults. The stakes are sovereignty. A state that cannot defend its money loses options, and in a system built on fixed rates, loss travels fast. Inside Basel, the work looks almost deliberately dull. A meeting room kept at a controlled temperature, leather chairs that swallow sound, folders laid out with clipped pages and tables, corners bent from handling, a wall map with pins, a chalkboard with exchange figures, chalk dust smudged where someone erased and wrote again. In the corridor, damp wool coats hang to dry. The air carries faint lamp smoke and old paper. Telex paper curls in a tray. Coffee goes cold in cups, leaving rings on blotters. Central bankers arrive from capitals where every monetary move has a domestic audience. Parliaments demanding growth, exporters demanding competitiveness, unions demanding wages. Here, the same pressures are discussed as shared constraints, not national embarrassment. Basel does not set a country's policy. It offers a stable room where monetary authorities can compare notes, move funds, and coordinate without turning coordination into a public fight. A hand turns a page and pauses on a column of reserves. Another hand aligns a ruler under a line item, then circles a number in pencil. Ink-stained fingers press a stamp onto a form authorizing a transfer. Coins lie in a small tray, edges worn, cold to the touch, beside paper slips marked with rates. A worn leather briefcase opens and closes with a tired buckle. Chalk squeaks, then stops. A sleeve brushes the board, leaving a grey smear. The post-war system is built to prevent the chaos of the interwar years. Competitive devaluations, sudden controls, panic that feeds on itself. But stability has a cost. Fixed exchange rates demand discipline, and discipline is rarely politically popular. If a country expands demand too aggressively, credit loose, spending high, imports rise, reserves drain, and speculators begin to test the peg. If a country tightens too hard to protect reserves, unemployment and unrest follow. Either way, the pressure finds a weak seam. This is where the BIS's role becomes less headline and more habit. Committees form. Information is shared with discretion that governments often envy. In a decade of prosperity on the surface, the machinery beneath can still choke. Settlement deadlines, reserve adequacy, the credibility of a convertibility promise that depends on confidence as much as metal. Basel becomes a place where central banks can acknowledge, to one another, what they cannot always say at home, that the system's legitimacy rests on restraint, and restraint has domestic consequences. Mechanism. Moment. How fixed rates force the hand. Under a pegged exchange regime, a central bank must stand ready to buy or sell currency to keep the market rate near its official level. That defence is paid for with reserves, foreign exchange, and in the background, gold. If demand for foreign currency rises, the central bank sells reserves to meet it. The transaction is physical in its aftermath. Vault inventories change, account balances shift, and paper trails accumulate, transfer orders, confirmations, settlement receipts. Each defence can calm a market for a day, but it burns a finite stockpile. When reserves thin, the options narrow. A central bank can raise interest rates, making domestic credit tighter and unemployment more likely. It can impose controls, signalling weakness and inviting further evasion. Or it can seek support from other monetary authorities, short-term credits, swaps, deposits, arrangements that look technical but function like emergency oxygen. Basel is suited to this because it can hold deposits, facilitate operations, and provide a discrete forum where support can be discussed without inflaming markets. It is quiet governance, not lawmaking, but constraint management. The language used, liquidity, stability, convertibility, is antiseptic. The reality is coercion by arithmetic. A state that bleeds reserves is compelled to choose between domestic comfort and external credibility. And credibility is not an abstract virtue. It determines whether trade finance is cheap or scarce, whether capital stays or flees, whether a government can borrow without humiliating terms. The system rewards countries that can endure restraint and punishes those that cannot, often with a speed that makes democratic politics look slow. Human constraints drive the negotiations. Central bankers fear the optics of dependence, because dependence invites political attack, yet they fear isolation more, because isolation can turn a manageable reserve drain into a run. Governments demand growth, electorates expect rising living standards, exporters demand a rate that protects margins. Each actor has an incentive to push costs outward, onto trading partners, onto the system, onto the future. Basel becomes a venue where those incentives can be acknowledged without being named as such. Material reality keeps changing. Europe rebuilds industrial capacity. Consumer goods spread. Cars, appliances, and new housing reshape expectations. But prosperity does not dissolve constraint. It disguises it. In the ledgers, pressure accumulates as repeated stress. Trade imbalances that do not correct. Reserve losses that return each quarter. Speculative probing that grows bolder when defences look thin. The attrition is slow at first. Small interventions, quiet credits, careful statements. Then it becomes a pattern, and patterns invite tests. Historical ambiguity. Contemporary records and later analyses differ on which specific episodes of speculative pressure mattered most. But the overall trajectory, rising dollar claims against limited gold, tightened year by year. By the end of the 1960s, polite coordination is no longer enough. The promise at the centre of the system is being asked to cover more trade, more credit, more cross-border claims than the underlying metal can plausibly redeem on demand. The world wants liquidity, and the system's legitimacy depends on converting that liquidity into confidence. When confidence begins to calcify into doubt, every central bank action is read as a signal, every reserve loss as weakness, every rate move as fear. Basel does not cause the strain. It records it, manages it, and tries to buy time. But time is not infinite. A system built on fixed points cannot survive if too many participants decide the points are negotiable. When convertibility finally breaks and money begins to float, the old discipline dissolves, and a banking system free to expand across borders will generate risks that only new rules can contain. When money begins to float, discipline doesn't vanish. It relocates. Fixed exchange rates once forced policy through rigid constraints. Now volatility becomes a normal condition, and banks expand across borders to chase yield and serve corporations that are expanding the same way. This creates a daily web of obligations that spans time zones and legal systems. In that web, a small failure can travel far, not through ideology, but through settlement. Who pays, who receives, and when. The geopolitical frame shifts from defending pegs to defending trust in the plumbing. Inside a bank, the risk is not a speech, it is a back office. Rows of desks, green-shaded lamps, stacks of paper confirmations, telex machines spitting out curled strips. Clerks in shirt sleeves stamp forms and file copies in metal cabinets. The air carries toner, stale coffee and cigarette smoke. Traders make calls. The deals are agreed quickly, but the settlement is slow, procedural, and unforgiving. Payment instructions move through corridors and across wires, and every step assumes the other side will still be alive when the clock reaches the next cutoff. In Basel, central bankers and supervisors gather in rooms designed for quiet. Leather chairs, carpet hush, files marked confidential. They are dealing with a new environment where cross-border exposure grows faster than national oversight can track, and where an operational problem, timing, can become systemic risk. A stamped supervisory memo, corners folded from handling, a settlement confirmation with inked signatures and a time printed at the top. Fingers smudged with carbon copy residue turn pages quickly. A hand taps a watch once, then again. A telephone receiver is set down too hard, then lifted again. On a blotter, a pencil has worn a groove beside a circled number. The tension sits in the smallest detail, an hour that cannot be retrieved. In 1974, the failure of Bankhaus Herstatt becomes the cautionary tale that central banks cannot ignore. It is not a morality play. It is a timing failure with teeth. Foreign exchange trades settle in different time zones. One leg of the trade can be delivered in the morning in one currency. The other leg is due later in the day in another. If a bank collapses between those moments, someone pays and does not receive. That gap is not just a loss for one counterparty, it is a crack in trust. And trust is what keeps the whole market from freezing. If banks begin to suspect that settlement risk is uncontained, they retreat, reducing exposure, demanding higher margins, cutting lines. The retreat is rational at the individual level and destructive at the system level. Trade finance tightens, liquidity evaporates. The market learns all at once that the world is linked by cut-off times. Mechanism. Moment. What settlement risk actually looks like on the ground. An FX trade is two payments that must cross in opposite directions. The deal may be agreed by phone or telex, but settlement depends on payment systems with operating hours, correspondent banks, and finality rules. One bank instructs its correspondent to deliver funds in, say, a European morning. The counterparty's delivery in another currency may not be processed until New York opens or until a different system cycles. The risk lives in that interval, the window where value has left one account but the offsetting value has not yet arrived. In 1974, that window becomes lethal when Herstatt fails during the day. Counterparties who have already delivered Deutsche Marks find themselves waiting for dollars that will never come. Contracts that assumed settlement becomes reality are suddenly exposed as assumptions. Back-office staff, staring at confirmation slips and cut-off schedules, discover that a bank's failure can turn time itself into a weapon. The market does not need many such failures to seize, it only needs enough to make everyone doubt. This is the ticking clock inside the chapter. Not winter, not siege supplies, but intraday hours. Each hour between legs of settlement is a vulnerability. Once that vulnerability is seen, it cannot be unseen. A system that clears smoothly on normal days can become a quagmire on the day confidence breaks. Basel changes in response. The BS stops being merely a meeting place and becomes a standard setting centre. Central bank governors create the Basel Committee on Banking Supervision to coordinate supervisory practices across borders, because national regulation alone cannot restrain banks that operate internationally. The core problem is legitimacy. Who has the authority to set expectations for institutions that move across jurisdictions faster than law can follow? Basel provides something rare: continuity, staff support, and a discrete forum where supervisors can trade information without turning every detail into a public dispute. The work is technical, but the incentives are not. Supervisory cooperation sounds polite until you consider what it implies. Sharing sensitive information about weak banks, agreeing on baseline expectations, and confronting the fact that if one country is lax, others import its risk. In a world of floating currencies and expanding cross-border banking, weak supervision is not a domestic choice, it is an export. From this comes an idea that will define the era: capital. The concept is blunt. If banks must hold buffers against losses, they are less likely to fail. If they are less likely to fail, settlement is safer. If settlement is safer, the system can breathe. But capital is expensive. It reduces short-term returns. Banks lobby. Governments fear credit contraction. Supervisors worry about competitiveness. No one wants their banks handicapped compared to rivals abroad. Every technical decision becomes a political fight in disguise, conducted in controlled language. The tension engine becomes a hard choice between discipline and growth. Too strict and credit tightens, investment slows, unemployment rises, and politicians turn hostile, too loose, and failure cascades, and the cost arrives later in a form that is harder to contain. Basel's committees become the arena where that balance is hammered out, quietly, persistently, through memos, definitions, and minimums that convert risk into arithmetic. Historical ambiguity. Accounts differ on how widely Herstatt-style exposure was understood before 1974, but the failure made the timing vulnerability impossible for supervisors to dismiss. After Herstatt, the lesson is institutional. Stability cannot be restored by speeches alone. It requires standards that make the plumbing safer, standards that can cross borders the way risk does. Basel begins to write those standards, not as law, but as expectations that banks and regulators ignore at their peril. And once capital becomes the language of safety, the people who profit from risk begin learning how to speak that language fluently, and how to bend it. By the late 1980s, the question has changed. It is no longer whether banks should be supervised, but how supervision can keep pace with institutions that operate across borders and across product lines. The world's credit machine is larger now, faster, and more interconnected, funding factories, mortgages, trade, and government deficits through balance sheets that can span continents. In this environment, a failure is rarely contained by geography. It moves through claims and obligations, through interbank lending and payment networks, until a local problem becomes systemic. The stakes are stability, but also sovereignty. A country that cannot keep its banks credible becomes dependent, constrained, and exposed. Inside Basel, the setting remains deliberately restrained, a meeting room where voices stay low, papers arranged in neat stacks, a wall clock that marks time without mercy. Drafts circulate with handwritten corrections in the margins. A risk weight table is passed around, highlighted and scribbled over, corners soft from handling. Outside these rooms, innovation is the public word. Inside, the mood is different, controlled, skeptical. Because every new instrument is a question. Does it truly reduce risk, or does it move risk into a shape that is harder to see? In banks, the material reality is changing. The centre of gravity shifts toward models and metrics. Balance sheets grow. Back offices hum with settlement, but now they also hum with measurement, categories, weights, ratios. Clerks still stamp forms. Traders still close deals. But more and more, the system runs on classification, what an asset is called, and what that name allows it to cost in capital. A pencil underlines a single number, 8%. A finger taps the margin beside a category label. Ink-stained fingertips flip a page and leave a faint smudge. A calculator clicks softly. A binder ring snaps shut. On a desk, coffee has left a dark circle on a blotter. The paper smells of toner. The quiet is not comfort. It is concentration. Because a ratio can become a boundary, a whole industry learns to walk. In 1988, Basel Firm arrives with a framework simple enough to fit on a single page, risk-weighted assets and minimum capital ratios. The principle is disciplinary. Not all assets are equally dangerous, therefore not all exposures should require the same buffer. If a bank holds riskier claims, it must hold more capital. If it holds safer claims, it can hold less. The system tries to convert judgment into arithmetic. On paper, it is rational. In practice, it rewires incentives. The moment you assign categories and weights, you create a map. Banks are paid to learn maps. They restructure portfolios to minimize required capital while preserving returns. This is not a moral failure. It is a predictable response to constraint. A minimum ratio becomes a target. A target becomes a design problem. Mechanism. Moment, how the arithmetic shapes behavior. Capital requirements are not a lecture, they are a cost. A bank that must hold more capital against an exposure is being told, in material terms, that this asset is expensive to own. Capital is not free. It is raised from shareholders, retained from profits, defended against competitors. So if a rule says one kind of asset requires less capital than another, banks have an incentive to hold more of the cheaper category, or to repackage the expensive one until it fits a cheaper label. This is where financial engineering becomes a response to regulation itself. Loans can be bundled, sliced, sold, insured, moved into off-balance sheet structures. Derivatives can shift apparent exposure without shifting the underlying economic reality. Securitization expands. Off-balance sheet vehicles proliferate. The public sees cleverness and growth. Supervisors see complexity and leakage, risk moving into corners where the ratio still looks healthy. Basel becomes the forum where this game is discussed without drama. The BS is not writing speeches. It is hosting the arguments over definitions that decide what counts. Every new product forces a question that sounds technical and is not. Is this genuinely safer, or is it simply disguised? Because if the disguise is accepted, capital buffers can shrink while leverage grows, and the system becomes more fragile precisely when it appears well managed. By the 1990s, the limitations of blunt categories become obvious. Banks insist that risk is more nuanced than fixed weights can capture. Supervisors, facing institutions that are larger and more complex, are pulled towards sophistication. This leads to Basel II, developed through the 1990s and finalized in the 2000s, leaning into internal models. Under supervisory approval, banks can use their own risk assessments to determine capital needs. The intent is precision. Align buffers with actual risk. The hazard is structural. Models can be optimistic. Assumptions can be self-serving. If a bank can persuade a regulator that its assets are safer than they are, it can run thinner buffers and expand lending, boosting profits, until the cycle turns. The incentives point in one direction, toward reassuring math. And reassuring math is contagious, because it makes everyone look competent at the same time. Human constraints press hard on every line of the framework. Supervisors fear being blamed for stifling credit, governments fear recession, banks fear being outcompeted by rivals in looser jurisdictions. Politicians want growth now and stability always, and those demands rarely align. Basel standards must be negotiated across countries with different banking systems and different political economies, so the result is always a compromise between what is prudent and what is possible. The tension engine becomes fragility hidden behind compliance. When risk is translated into numbers, it can be managed, but it can also be underestimated with an appearance of legitimacy. You don't need a conspiracy for this. You only need incentives aligned toward optimism and a shared belief that volatility can be tamed by the right spreadsheet. Historical ambiguity. Analysts still dispute how much Basel capital rules directly drove specific waves of securitization and off-balance sheet growth, but the broader incentive effect, treating capital as a constraint to be optimized, was widely recognized. By the mid-2000s, the system is carrying an enormous volume of credit through structures that are complex, model-rated, and often thinly capitalized relative to their true stress behavior. Basel's arithmetic has become the language of safety, and the industry has become fluent in it. The question is no longer whether the ratios can be met. It is whether meeting them means what it appears to mean when fear returns and liquidity disappears. And when the global credit machine seizes in 2008, Basel's numbers face panic, and the response shows what this hidden hub becomes when models meet reality. In 2008, the map of finance doesn't break at a border. It breaks along funding lines that cross oceans overnight. The old image of a bank run, people in coats outside a branch, doesn't capture it. This run happens inside wholesale markets where institutions live on short-term borrowing and the promise that tomorrow's rollover will arrive. When confidence fails, liquidity becomes a weapon, and the clock is measured in hours, not quarters. The stakes are legitimacy, not only whether banks survive, but whether governments can preserve sovereignty while rescuing the machinery that keeps wages, trade, and payments moving. A trading floor at dawn, fluorescent light, stale coffee, the dry hum of servers. Screens glow with prices that flicker faster than anyone can narrate. Printers spit out risk reports on perforated paper. The edges curl as they land in stacks. Phones ring and stop, then ring again. In conference rooms, suits sit with jackets still on, damp wool from rain, collars slightly darkened, while lawyers and risk officers pass binders with tabs and clipped pages. Outside those rooms, the material world turns harsh quickly. Firms cut jobs, projects stop midstream, governments argue over bailouts and austerity, while tax revenues sag and obligations stay fixed. On the street, the crisis becomes unpaid bills and foreclosures. Inside institutions, it becomes the same question, repeated in different forms. Can we fund ourselves tomorrow, without detonating confidence today? A margin call notice arrives. Plain paper, red ink totals, a deadline stamped at the top. A hand with ink-stained fingers circles the number, then taps it once against the desk. A plastic security badge hangs from a frayed lanyard, twisting as someone leans in over a keyboard. A cracked leather briefcase sits open, its zipper half broken. A pen cap is chewed, a coffee ring spreads on a blotter, and the air smells of toner and overheated electronics. This is not panic as noise, it is panic as procedure. The crisis is often sold as a morality play. Greed, recklessness, collapse. The mechanism is more mechanical and more frightening. It is a run, not on deposits held by households, but on the wholesale funding system modern finance uses to keep itself moving. Banks and shadow institutions fund long-term assets with short-term borrowing, repo, commercial paper, overnight lines that assume markets will always renew. That assumption is the fragile hinge. When confidence breaks, institutions that look solvent on paper discover they cannot roll funding. They may own assets that will pay out eventually, but eventually doesn't settle obligations due at 9 a.m. Liquidity, not solvency, decides who lives through the week. Once lenders suspect they might not be repaid tomorrow, they retreat today. Haircuts rise, collateral demands tighten. The system starts rationing funding the way a besieged city rations bread. First to the weak, then to everyone. Mechanism. Moment. This is what a wholesale run looks like in the plumbing. A firm borrows cash overnight by pledging securities as collateral. The next morning, it must repay or roll the loan. If counterparties refuse to roll, because the collateral is questioned or the borrower is suspected, the firm must find cash elsewhere, immediately. To raise cash, it sells assets into falling markets, pushing prices down and making collateral look worse. That triggers more margin calls, which triggers more forced sales. The spiral is not psychological decoration. It is a chain of deadlines printed at the top of forms and enforced by systems that clear automatically. The run moves through screens and settlement cutoffs, not through crowds. In this environment, central banks become the backstop of last resort. But the crisis is global, and the world's funding currency is the dollar. Banks outside the United States borrow dollars to fund trade and dollar assets. When dollar funding markets freeze, the problem is not national pride, it is survival. Swap lines between central banks become critical. Dollar liquidity arrangements that allow foreign central banks to provide dollars to their domestic banks without waiting for markets to thaw. This is where the hidden hub matters. The BES is not a global central bank and it does not save the system, but it is a forum where the habit of cooperation has been built for decades. Shared language, shared technical understanding, channels that can be activated without weeks of negotiation, while confidence bleeds out by the hour. The political problem is brutal. If governments rescue banks, they risk being seen as protecting finance, while citizens absorb unemployment and austerity. If they refuse rescue, the payment system and credit supply can collapse, pulling the real economy into a deeper quagmire. It is a hard choice between two bad outcomes, and it is made under a ticking clock. Markets open in the morning regardless of parliamentary schedules. Out of the catastrophe, Basel translates panic into reforms. Basel III emerges as an attempt to harden the skeleton of banking. Higher and better quality capital, liquidity coverage ratios, leverage ratios, and macro-prudential buffers. The emphasis shifts from assuming markets are self-correcting to assuming stress is inevitable. The reforms are dense because the system they aim to stabilize is dense. Simplicity would be a disguise. Capital becomes less negotiable, more common equity, more loss-absorbing capacity. Liquidity standards force banks to hold buffers of safe assets that can be sold or pledged in stress. Leverage ratios try to constrain the quiet build-up of balance sheet size even when risk weights look benign. Macroprudential tools acknowledge something earlier frameworks treated as secondary, that the system can be fragile even when individual institutions appear compliant. But every mechanism changes behavior. If liquidity standards tighten, banks hoard safe collateral, and the cost of funding shifts. If capital requirements rise, activities migrate toward less regulated channels, shadow banking structures, off-balance sheet exposures, and contractual arrangements that can hide leverage in corners. Risk doesn't vanish, it relocates. The balance sheet looks cleaner while the obligations accumulate elsewhere, in forms that are harder to supervise and faster to run. Human constraints shape the final compromise. Policymakers want resilience, but they fear choking growth. Banks accept stronger rules but fight the details, definitions of capital, treatment of derivatives exposures, the calibration of liquidity haircuts. Different countries protect different champions. Every compromise creates a seam where stress can rip later, and every seam is defended as pragmatic until the day it fails. Historical ambiguity. Analysts still debate which specific regulatory gaps mattered most in 2008. But there is broad agreement that short-term wholesale funding and opaque leverage turned a correction into a systemic run. The deeper tension is legitimacy. If the public believes finance is insulated while households bear the cost, politics destabilizes and the state's authority calcifies into coercion and resentment. If finance is forced to absorb too much adjustment too quickly, credit contracts sharply and unemployment rises, producing its own kind of desolation. Basel standards aim to prevent both, yet every adjustment shifts burdens somewhere, onto borrowers, onto banks, onto governments, onto the future. The reforms harden the core, but they also teach the system new habits: how to comply, how to optimize, how to push risk into structures that look acceptable on paper. The decisive test is not whether rules exist, it is where obligations accumulate when the rules bite. As banks adapt and shadow channels expand, the next systemic threat won't always sit in plain loans or mortgages. It will gather in the plumbing of global currency, where obligations can build out of sight until the clock starts again. Today the fault lines are less visible on maps and more visible in funding curves, data feeds, and cross-currency obligations that reset overnight. The old dangers, default, reserve loss, contagion, haven't disappeared. They've migrated into contracts that roll quietly from one maturity date to the next. Dollar hegemony still shapes the terrain, not as ideology but as plumbing. Trade invoicing, collateral chains, margin rules, and the simple fact that many balance sheets must source dollars on demand. In calm conditions, this looks like routine lubrication. Under stress, it can become a choke chain, tightening with digital speed. In Basel, the institution is no longer only a discrete meeting place. It is also research staff, committees, and technical projects, rooms where central bankers sit beside engineers and legal specialists, treating currency stress like an operational problem that can be measured and routed. The space feels modern, but restrained. Glass, pale stone, the hum of servers, screens washed in cold light. A terminal displays maturities in stacked rows. Paper still exists, briefing packs with clipped pages, highlighted paragraphs, and margin notes. But the centre of gravity has shifted towards systems, how money moves, how data is shared, and what failures will look like when they arrive at machine speed. In a corridor outside, coats hang to dry, damp wool, winter air still caught in the fabric. On a side table, coffee has cooled, leaving rings on a blotter. A printer feeds out charts that show smooth lines until they don't. A finger scrolls through a list of swap maturities, dates repeating like drum beats. A cursor pauses over a single line item. Ink-stained fingers turn a page where liquidity is underlined twice. A plastic badge twists on a frayed lanyard as someone leans over a keyboard, fingertips leaving faint prints on glass. A stapled memo has corners folded from handling. The room smells of toner and warm electronics, and the quiet carries the weight of a simple fact. When the rollover fails, there is no time to debate definitions. In the modern era, Basel's hidden hub is not only about capital ratios, it is about the infrastructure that decides what safe means, what liquid means, and what can remain invisible until it suddenly isn't. The BIS runs research, coordinates committees, offers banking services to central banks, and hosts projects through its innovation hub. Its influence is often indirect. It standardizes language, spots vulnerabilities early, and helps build systems that later become normal, so normal that people forget they were choices. One vulnerability has a cold, technical name: foreign exchange swaps. They are widely used because they solve an everyday problem in a world where assets, liabilities, and cash flows sit in different currencies. The mechanism is straightforward in feel and treacherous in stress. An institution that needs dollars can obtain them by swapping another currency as collateral, with an agreement to swap back later. The trade is not framed as borrowing in the same way a conventional loan is framed, and the accounting treatment can make the obligation less obvious on a balance sheet than plain debt. The result is a large volume of short-term currency funding that can accumulate quietly, rolled again and again, maturity after maturity. Mechanism. Moment. What the run looks like when it lives inside swaps. Picture the daily discipline of the contract. The institution receives dollars now and promises to deliver them back at a set date, while posting another currency or collateral against the exposure. As prices move, margin rules bite. Variation margin is demanded. Haircuts change. Collateral calls arrive with deadlines stamped at the top. In calm markets, the rollover is routine. Emails, confirmations, settlement instructions, a back office ticking boxes. In stress, the rollover becomes a test of confidence. If lenders refuse to roll, the borrower must find dollars immediately, not next week. It sells assets, draws lines, hoards cash, and pulls liquidity out of wherever it can, often worsening the stress it is trying to survive. The run is not people outside a branch. It is contracts, cut-off times, and margin calls enforced by systems that do not negotiate. This is not speculative fiction. The BIS has warned about the scale of the FX swap market and the risk of a future scramble for dollars if positions unwind rapidly. The structure resembles 2008's wholesale run, but with a sharper edge. Obligations can reset and reprice at digital speed, and the visibility of the exposure can lag behind the reality of the stress. When the market turns, what looked like a routine funding habit becomes an urgent question of operational capacity. Can central banks supply foreign currency liquidity fast enough to prevent a cascade of forced selling and defensive hoarding? And then the political constraint arrives. Swap lines and emergency facilities can stabilize funding, but they can also look, domestically, like patronage for finance. That is the hard choice. Provide liquidity and risk the charge that institutions are protected while citizens absorb the cost through unemployment, inflation, or austerity debates. Refuse liquidity and risk a blockade of trade finance and payments that harms the same citizens through shortages and contraction. The decision is made under a ticking clock hidden inside contracts. The maturity wall is not a metaphor, it is a schedule. Alongside this, Basel's attention shifts to digital rails, new ways to settle money and record claims. Central bank digital currency experiments and other payment innovations promise cleaner settlement, fewer intermediaries, and reduce certain forms of risk. But speed cuts both ways. A faster rail can reduce friction. It can also accelerate failure. A system that settles instantly leaves less time to contain a mistake, less time to halt a cascading margin spiral, less time to interpret whether a move is a normal transfer or the start of a run. Digital systems also create new attack surfaces and new governance dilemmas, surveillance, access control, and geopolitical leverage over payment networks. The question is not only technical, it is legitimacy. Who can see, who can freeze, who can be excluded, and under what authority? Basel does not decide national policy. It shapes the menu of options and the vocabulary used to justify choices. That is a form of quiet governance. When the next crisis arrives, officials will reach for tools whose logic has already been rehearsed in committees and prototypes. How to provide foreign currency liquidity, how to measure off-balance sheet obligations, how to route payments when private channels are choking. The public may see a single announcement. The real action is the standard, the protocol, the eligibility rule that decides what counts as collateral and what does not. Historical ambiguity. Measuring the true scale and maturity concentration of FX swap obligations is difficult because reporting and accounting treatment vary, and some exposures are disclosed unevenly across jurisdictions. In calm times, swaps look like routine arithmetic, and digital rails look like progress. Under stress, both reveal the same truth. The system is governed by constraints written into code, contracts, and cut-off times. Basel's power is not a decree. It is the ability to frame what will be treated as normal and what will be treated as an emergency when the clock starts again. And that is the answer to our opening suspense. Not a single rescue, but the quiet architecture of rules and rails that decides in the moment of panic who has room to breathe. Back in Basel, the building is still quiet. The carpets still swallow footsteps. The clock still measures time without emotion. That's the point. The bees was never designed to look powerful. It was designed to make power legible to other powers, central banks, supervisors, treasuries, so they could coordinate without collapsing into public contradiction. The opening question was never whether a crisis would come. It was whether the system would break where people could see it, or break where only specialists notice, inside definitions, settlement conventions, and the rules that decide what counts as risk. In the interwar years, the BIS is built to manage coerced payments. In wartime, it survives by continuing operations and bears a moral stain that history still argues over. In the post-war order, it avoids abolition because Europe needs clearing more than symbolism. In the modern era, it becomes a factory for standards, capital ratios, supervisory expectations, and shared language. Basel does not govern by law. It governs by shaping what regulators enforce and what banks build their strategies around. The costs are real. Tighter rules can restrain credit. Looser rules can invite collapse. And now, in a world of shadow obligations and digital rails, the hidden hub confronts an old problem in a new form: liquidity that vanishes in seconds and sovereignty that depends on infrastructure it does not fully control. When stability is built from quiet rooms and technical rules, who decides which costs are necessary, and who is forced to pay them? If this format helps you study, reflect, or sleep, you can like the film and subscribe for more. If you want the full meaning of the ending, rewatch the final 5 minutes. Details were planted early. You can support the research through Buy Me a Coffee. The more support this project receives, the faster we improve sourcing, visuals, and production.